Well, welcome everyone to today's webinar on navigating changing fee structures, leading practices for payment strategy. This is Brian from Strategic Treasurer, and we're pleased you could join us as we discuss how to manage fluctuating bank and payment card fees. Our speakers for today are Tom Wrigley, Payments Consultant at Optimized Payments, Christin Cifaldi, Director, Product Development and Analytics at Strategic Treasurer, and Stephan Ireland, Senior Director, Head of Sales and Business Development at Strategic Treasurer. Welcome, Tom, Christin, and Stephan, and I'll now turn the presentation over to you.
Thank you, Brian. Hi, everyone. I'm Stephan. Just a heads up, I have a very strong Texas accent. For those who don't understand me, ask your question in writing, and I'll do my best to answer them in the best accent you ever heard. Howdy. I like this. I like to do this joke. So today we're going to cover a few points about the fascinating topics of bank fees and payment card fees. We decided to join those topics, and I'll tell you why later, but we'll talk about the connection between the two, of course. They do have similar problems or challenges that we'll cover, and we'll try to address, how to manage both of them, what makes them difficult, where the challenge comes from, and moving forward, what would be the best advice and tools or best practice to get them under control. Just wondering, Tom, how we did that, comparing bank fees, payment card fees, and you see, guys, after this slide that they have a lot of commonalities. On the bank fee side, think of it, there is about 2,500 ways to price bank fees only in the United States. When I first came here, like maybe 10 years ago, I was like, this is like speaking a foreign language. There is way too many words I don't understand. And the cool thing is that even if I want to try to understand this language, they keep changing the rules. So I don't know how to do that. But you understand my point, right? It fluctuates a lot. It fluctuates because the surveys are hard to understand. It's not clear, and there is a lot of change, not only in price, but also in service description, and we'll cover more of that. What about you, Tom?
Yeah, thank you, Stephan. I think payments is very similar in that regard. You have interchange fees being charged by the issuer. You have your processor fees charged by the acquirer, then your network of fees charged by the network brands like Visa and MasterCard. And it's really hard to tell what fees are coming from where and how much money is coming in and out. All these different reports are vary by processor. So merchants have a really hard time, speaking the language of payment fees and the sales coming through. So I think that's a major commonality between bank fees and payment fees. You're going to see overlap in being able to decode the reports, being able to report on different fees that you have coming in, and then trending those fees over time. So like you said, there's no benchmark that's going to remain the same, and these are going to change from year to year, month to month even. And being able to decode that is the biggest strength a merchant or a company can have. I agree.
Yeah, correct. And as you'll see, guys, there is another common point is that if you do nothing, that's going to cost you something. So that's what we're going to try to tell you what is the cost of not doing something here, and what should you do, and how can you do it. So let's dive into it.
Yes, so I'm going to kick it off with the complexity of payments acceptance in the whole payments ecosystem. So when we look at the payments ecosystem, there's a lot of little parts that come into it, and here we've outlined them from a high level. So for example, payment methods, depending on the payment methods a merchant is accepting, their cost of acceptance is going to vary. Debit cards are going to be different than credit cards. ACH is going to be different than both credit and debit. Digital wallets are going to change, and then there's also alternative payments. Especially once you get into the European and the Asian Pacific markets, alternative payments make up a larger portion of the payments there. But each of these has a different cost of acceptance associated with it, and a merchant's overall effective cost is going to change as a result. So these are all just different variables that a merchant should take into account when looking at how much they're paying in fees. Fee structure. So there's a couple different fees like I outlined on the previous slide. Interchange rates are going to make up the majority of your fee structure, and those go straight to the issuer. So this is about 95% of the fees you're going to pay. And if we can just pop back one more slide, Stephen, thank you. Assessments are going to go to your networks. So Visa and MasterCard have set network assessments that they charge. Processor fees go to your acquirer. And then obviously there's fees related to chargebacks and other aspects such as tokenization, etc. Regulatory compliance, we usually don't see these in reporting, but you're going to have regulatory fees such as PCI, making sure your security standards are up to par with the agencies. And then there's also technology integration, so gateways, POS terminals if you're a card present merchant, and then back office systems. So all of these come in together to the payments ecosystem, and merchants should be aware of how much they're spending each month, each year on each aspect. Going into interchange, so I said this was about 90% of the fees a merchant is going to pay. But what is interchange, right? So interchange rates are published by both Visa and MasterCard, and they go straight to the issuer, and it's to pay for their chargebacks and rewards programs primarily. So if you get 3%, 4% by going to a restaurant, what is paying for your rewards when you're using a credit card? It's interchange. So merchants are paying for your rewards to shop at their restaurants or shop at their boutiques per se. And then they just take profit as well off of that. So the US, though, overall has the highest interchange in the developed world. So in Europe, in Australia, and all these other markets, the government has much more regulation than we do in the US, especially on the credit card side. So you're going to be paying more to accept these credit card transactions, debit card transactions in the United States compared to other nations across the world. And then we also want to get into these interchange fees can be managed, and you can also go to the card networks and negotiate them. So there is room for a merchant to receive lower interchange rates and a couple of these variables, which we will get to on the next slide. So a couple uncontrollable factors for interchange. There's different card types, right? So if you have a Visa card, for example, you can have a Visa traditional card, a Visa rewards card, Visa signature. There's a lot of different rewards and tiers that come with these card categories. So your Visa traditional card is going to be a basic credit card, and there's not going to be much in the rewards with it, right? You won't be getting 5% cash back by going to restaurants. You won't get airline miles. You won't get any of those rewards associated with it. And those are the cheapest cards for merchants to accept. The interchange will fluctuate depending on the card category being accepted by the merchant. Visa Rewards is a tier up. Maybe you might get 3% cash back. You might get a little more. And the Visa Signature will be your high-end Visa card where you're going to be getting airline rewards, hotel rewards, restaurant rewards associated with it. Debit cards are the cheapest to accept. There's no real rewards associated with it. I just noted it here. So if you have a higher debit concentration than credit, that will benefit your interchange effective cost. MCC, merchant category code, is another factor to take into account when looking at interchange. That is how a merchant is classified as either a restaurant, a hotel chain, and there are different interchange rates associated with that because there's different rewards as well. So depending on your MCC, and there is some gray area, and you can go to your card brand or processor to have your MCC changed, but primarily it's going to be uncontrollable. If you're a restaurant, there's no room for remediation there in changing interchange. Method of entry, so card not present is going to be more expensive than card present transactions. And then one time versus recurring as well. There's different interchange fees associated with both. So merchants should take that into account when looking at what they can control and what they can't. And then lastly, transaction amount and ticket size. So if you have a lot of small ticket transactions under $5, for example, your effective rate may be higher unless you negotiate with card networks to get like a VPP or MPP rate. But that's hard to control because you're affecting consumer behavior then, and then there's an impact to costs associated with it. Getting on to some of the factors we can control, business processes, so downgrades, data that's being passed with the transaction. If the merchants aren't passing the correct data under Visa's and MasterCard standards, then they're going to be getting downgraded and you're going to be hit with a higher interchange rate. And then a transaction integrity fee as well on Visa cards, but that will raise your effective cost. So it's good to have an awareness of what data is being sent, what interchange descriptions are being passed through, because to be aware of the downgrades, you can actually control that and then lower your effective cost. Level 2 and level 3 data pertains more to commercial cards. So passing data associated with that can also lower your commercial card volume. Commercial cards are more expensive than consumer cards, so any room for mitigation there will be beneficial to a merchant. And then PIN and pinless debit routing. So the PIN and PIN debit networks are cheaper than credit networks to route debit transactions to. So looking at the ability to route, some processors will support it, some don't. So it's really good just to have an understanding of where savings can be had there. And then small merchant network tokenization, there are benefits to tokenizing transactions on card not present Visa consumer. And then small merchant, there's also interchange benefit to be classified as a small merchant. And this is one of my favorite graphics to show with the card mix and consumer credit issuance since 2010. We can see, like I said, Visa signature cards, Visa rewards, and Visa traditional. And we see the interchange costs that they make up on the right side. So as you see, Visa traditional is 1.89%, where your signature is going to be 2.5. So significantly more to accept. And what the issuers have been doing most recently is issuing Visa signature in a higher percentage than your traditional. So you're going to be paying more in interchange and you can't control it because these are cards that the merchants are all accepting, right? You can't just turn away Visa traditional at your point of sale in your gateway for a Visa traditional card instead. So you're going to be forced to paying these higher interchange fees, even though rates aren't necessarily increasing, just the percent of card issuance of these higher cost cards are. So one big topic we wanted to point out during this presentation is the evolution of payments throughout the years. Here we have some highlights. There are certainly more large events that have changed in the payment space, but just a few that we wanted to point out and show how this is a ever-evolving silo, just like bank fees. There's always changes being made, and for a consumer or for a merchant not to stay on top of it is really going to be a net negative, right? So to be in control of this evolution of payments and know what's happening in the space will benefit you more than it will not. So in 2006 and 2008, MasterCard and Visa went public. I was surprised it wasn't sooner. But here we see that interchange and network fees have grown significantly since then. And they're trying to line the pockets of the stockholders, right? So they're have earnings coming through. They want positive earnings. So they're creating more interchange and network fees to grow their stock price. In 2007, they announced account level processing. So if you look at the first 6 digits of the BIN, you used to be able to tell the card classification. This changed. So you wouldn't be able to tell card classification by looking at the first 6 digits, and now it's just at a card level. So this goes back to your Visa signature categories. They could be on a significantly larger portion of BINs, and we wouldn't be able to tell. In 2011, the Durbin regulation was passed, and that fixed debit card rates to 5 basis points and 22 cents. But what we saw come from that is that networks have increased their other fees to make up for this difference that they were seeing in profit. So Visa came out with the Vanna fee, network fees were established, and more issuers shifted to credit in order to recoup some of these fees they lost with the Durbin regulation. Apple Pay and Google Pay, I know everyone has Apple Pay on their phones now, Apple Wallet. This is just a new complexity that merchants were having to change for. So to accept card present, Apple Pay, you had to either pay for a new POS terminal, pay for new updates. Same thing goes for a gateway on card not present updates. You had to pay for a new gateway support so that you could take these alternative payment methods and merchants could accept it. EMV liability shift, that's the chip within the card. So it shifted a fraud to more card not present transactions. So it was harder to skim credit cards. CIT and MIT, that was more related to approvals and declines. So it created more complexity there, and then more decline issues with merchants. So it's just harder to get approvals. And then Visa claims resolution. It was made to streamline disputes, but what we saw is disputes didn't go away. It only increased, adding new fees that merchants had to be aware of, and it increased your effective cost basically. Visa introduced network tokenizations in 2022. And what that was, it was incentives for passing tokens on card not present Visa consumer transactions. And under that, if you weren't passing tokens, you were going to be hit with a higher fee as a merchant. So having the ability to know what transactions you're tokenizing is certainly big now, but it was larger back then in 2022 when that change first occurred. Um, Moving on to debit routing for card not present. Back when the Durbin regulation was passed, there was a little ambiguity to what eligibility basically consisted of for routing card not present pinless transactions, and this cleared that up. So they were making it so that there are more eligible networks for card not present debit. And now, 2024, what we're seeing is level 2 is going to be going away in 2026 on commercial card transactions, and it'll only be a new commercial level 3 enhanced program on Visa. So, as you can see, a lot of changes. I really went through them quickly just because there's so many, but this just adds to the complexity of the card payment space. If I was a regular merchant with a group of 2 people on my team, I'd have a hard time deciphering what these changes are gonna, how they're gonna impact our organization and the new fees and benchmarking the new fees that are gonna come with them. So it really puts into perspective, though, the amount of changes that are occurring every year within the payment space. Here, we want to demonstrate how analytics simplifies all these fees and all these different descriptions that are coming in from the card brands, right? So on the left side, we have payment vendors and data sources. Depending on what payment vendor you have, like bank, you're going to get different reports from them. So your Adyen, your Chase, your Fiserv, Bank of America, all of those payment processors are going to provide a different report to their merchants, depending on sales, acquiring fees, network fees, interchange. You're going to receive a different report from each one, and none of them are going to align with each other. So what analytics does is it normalizes this data and it creates a tool that's digestible to the more individual person. So on the right side, we show how we normalize this data. We put it into different groups based on authorizations, based on settlements, interchange and fee data, and then your chargeback data. So all these have different fees associated with them, and to normalize them and be able to digest them in a readable report or a readable visual is massive for an organization. It allows you to talk to upper management. It allows you to create different reports within your company in order to display trends and different benchmarks that you're seeing within your payment space. We have a couple of dashboard examples here as well. So kind of like I touched on the price of doing nothing. I know Stephan brought that up, but what we want to do is we want to track the effectiveness of different cost saving strategies. So initially, if you set up your payments analytics, you're going to be looking at the low hanging fruit. Where can we find the most savings in the quickest fashion with the least amount of effort needed, correct? So once you find those and you start really finding different ways to optimize, you can see where the rest of your savings will lie with analytics. So being able to manage expectations to upper level management is going to be massive here. And then being able to prioritize, right? So you'll be able to prioritize, hey, we have a higher level 2, level 3 opportunity than downgrades. So as a team, we can create a project for this first. We can set timelines, and then you can slowly move through different parts of your payments ecosystem to optimize these different facets. And then lastly, I like dashboard visibility the best. It's not all about just fees and trying to manage those, but it's also general KPIs, right? So being able to reconcile to your banking statements. I know a lot of our merchants really like to look at what they're receiving from their bank and look at what they're receiving from their payments processor, and being able to look at both and reconcile, hey, we have these fees going out on this day. It's coming from our bank account on this, and when different sales are settling. So it's all just a good check just to make sure your reporting is correct and that your PSP and bank are both reporting the same thing. But what we offer in our dashboards and what you can see in dashboards if you create them on your own is you can group them up so you can look at different KPIs. So if a certain location has an issue, it's a major way to look into different downgrades because maybe certain locations are only witnessing downgrades or different categories. If you're a merchant that has both card present and card not present, you might have an issue that falls under one of the verticals and not both. So being able to pinpoint those issues with grouping is also major with dashboard visibility. And like I said, transparent reporting ties it all together. And as a treasury team, it really allows just to report the correct information and go to upper level management with findings. And I think we have a poll question, Brian. So if you'd like to answer the most appropriate for how your company currently handles payments data, we can provide a little bit of our thoughts on that. Hey, Brian, am I supposed to see the results in live time? Oh, never mind. There we go. Beat me to it. So how does your company currently use payment data? Regularly analyze it for insights and cost optimization is 42%. So that's really great to see. Just that you're staying on top of the flow coming in as these changes occur. You're aware of the impact to your organization and your bottom line because that benchmark's slowly going to trend up. As we've seen, like I said, fees are just going to increase over time. And if we extrapolate from that, they're going to continue to go up. So to stay on top of them, especially finding optimizations, is major. Only review reports occasionally is 21%. Rely mainly on processor acquirer summaries. So both of those, I'd say, just holding your processor honest. We have seen processors with bad reporting in the past. So being able just to look at it on your own end and reconcile to what the processor's saying and what you're thinking, I think that's a really good room to find an optimization possibly. And then unsure or don't use payment data actively, 23%. Once again, I'd highly recommend using analytics just to dig into payment data and find certain optimizations. Going to your processor and asking for different reporting is probably the first step in doing that, just to get a nice analysis and benchmark to begin with.
My turn. Thank you, Tom.
Thank you.
So yeah, bank fees, payment card fees, when you just have a look at the statement, you understand why we're having this presentation. It's like there is nothing you can really get out of those statements. You read them, it's full of figures, so the analytics is really a way to regroup, understand, and track. The same here, we have this kind of a equation. I think I probably badly copy paste this because we're missing the the trait, but there is an equation about or something to solve about bank fees. It's people track and they want to optimize, but as called, it's complicated when you read those statements. There is the complexity of the number of transactions, the change in transaction. It takes times, and when we do it, sometimes we can lack attention, we can make mistakes. That drives inefficiency and certainties. At the end of the day, it's cost, and we're going to cover what is the cost. So when we don't manage bank fee, Christine is going to show you in a little while some research, some study that we've done over time, not only about the natural cost inflation of bank fees, but also the little things that just keep add on as you go and how much they cost you. We're trying here to bring the case of having a tool. The tool can be Excel, of course. The tool can be just you reading a statement and trying to look at those fees and track them. Because otherwise, the other question is going to be, am I overpaying in bank fees? And it's not like to be like the say, yeah, bank fees are expensive and you're overpaying. But yes, if you don't do anything with bank fees, you're going to overpay. And it's not a fault of your banker or your relationship manager. It's not, there is nothing. It's just like in the US, there is this massive thing about bank fees, 2,500 codes, AFP codes. On average, I think about 170 line that you have to review all the time, and they keep changing. They keep changing. You do nothing, yes, 100%, you're going to be overpaying. How much? We'll cover that. We have graph, etc., to go through that. So here, the key point for us is to say, go get an analytic, do something with Excel if you want to reinvent something by your own. review eyeball, but eyeball is probably not enough when you have so much line to cover. Just another example. I just mentioned AFP, 2,500 different codes. In 2020, AFP reviewed the entire AFP codes. They haven't done that for a decade, and you're going to be surprised. Only 32% of the codes remain, and they had to refresh, update, eliminate other codes because there is new trade issue, there is alternative payment, you have those Ys and things that were not even existing in the past. So yes, it does change. And yes, there is a cost. And yes, Christine is going to tell you how much.
Thanks, Stephan. So glad that everyone could join us today. So we've been collecting bank fee data for over a decade now here at Strategic Treasurer. And when we drill down into it and analyze it, we've found that the natural cost inflation over time is about 7% a year. So if you're not checking in regularly with those bank fees to make sure they're reasonable, or just doing a quick cursory, okay, this is good, it doesn't seem, crazy, they will slowly creep up on you year over year. In addition to that natural cost of inflation, there's also about another 7% that can be attributed to unused or inefficient services. So if you're not reviewing your services, for example, fraud services, those change pretty frequently. Your bankers can put you into upgraded brand new products. But if you're not watching that, sometimes you have some legacy products. Sometimes you're not using the cutting edge, leading standards. And those can be a little bit cheaper if they're, for the banker to not maintain an old service for you. So just making sure we're maximizing our services that we're using. And if we no longer need it, we drop it. And having those regular check-ins with your bank, your relationship manager, just to ask them, what are you launching? Is there anything new? Can it save me money? Is it appropriate for my business? The other thing we notice when we go through reviews here at Strategic Treasurer, the average number, as Stephan said, of line items is about 177. So that is a lot to keep track of. And after we review it, that generally drops by about 20 items, just catching things, very simple things like paper statements and faxes that people don't even know where they're going anymore, but they just get left on if you're not keeping up with things. We also find that there are like lost opportunities that if you're not actively reviewing things, there's dormant accounts. One of my favorite examples is we found an account that the client had thought they closed 7 years prior. So the account was just sitting there, very minimal, maybe about $500 a month. We're getting accrued to it, no transactions running through, but that adds up over time. And then you also have this account sitting out there that fraud could be committed on easy because you don't even know that it exists. You think it's closed. There are, I mentioned inefficient services, unnecessary services, duplicates. Sometimes we've got reporting that we were signed up for, and then we started using a bank portal and we can grab that reporting a different way. So that's just an example of something that can be duplicative. Emails that are still turned on for staff that may no longer be with you or has moved on to a different department, and other alert type services. And just sometimes we're billed incorrectly as well. That's what we mean by price inconsistency. So maybe we've entered into an agreement with our bank that's a 1 to 3 year agreement, but they have an automatic system update, and all of a sudden your account maintenance goes from 25 to 35. If you're not reviewing it, you're owed a credit back based on your contract, but if you're not actively catching that, you don't even know to request it. Anything to add there, Stephan, on that one?
Well, I would just comment the left slide, the left graph, which seems to be, I did it, so I'm probably the only one to understand it. And maybe it's gonna talk just for me, I don't know. When we review our data, we try to understand, like we had of course, we've done many engagement and we have many data. So we look at this as a portfolio of data. The 6.8% you see as a mean here, this is the average cost of doing nothing. But some people are very good they only have 0.4% of their yearly cost of bank fees. There is not much to add, and it's clean and no problem. Some people are not very good. We have seen as much as 22% in terms of services. The right graph here. When you accumulate of this, sometimes it can be really, really costly. These are real example. I'm not here to make you scared of whatever. It's real example. The first and the third quartile, like those are statistics, varies between 3 to 17%. Median, meaning that's the bar that separates two universe. Really the middle of it. People, we've seen 7% on the long run. So that's it. It's just like we want you to be aware, and we know it's difficult, but it pains us really when we see that we can solve it, but we prefer that you do it yourself.
Thank you. And here's just a simple regression analysis. This is our data from the last 3 years. And as you can see, those costs are trending up over time. And like I said, this is an average of every data point that we've collected. So this includes your general services, ACH, fraud, online reporting, all of that's rolled in. And if you don't keep on top of it, that trend just keeps going up.
And it's okay that price increase, inflation is here, okay? COVID, and we all know what's going on with trying to get those prices under control. 7% average over time, it's higher than inflation. So that requires your full attention. I think we're going to have another poll here for the most courageous of you that are here. It's all about how do you manage your bank fees. Like if you use a specialized system or provider, an ERP or TMS, a specialized system will be something totally independent, like you have a specific tool. Sometimes there are bank fee modules in the TMS or an ERP that you can use. You can also have fun with Excel or do it manually. You can also decide not to do it. Up to you. And if you don't know, you don't know. Tell us. Excel won again. Congratulations.
Excel always wins.
Excel, my best friend. I love Excel, by the way. You're not a consultant if you don't like Excel. Specialized providers, okay. That's not a lot. TMS or bank fee module within the TMS is not a lot either. I would have expected a bit more here. Excel, I'm not surprised. And thank you for doing it. You have to do it. It's just like, I'm curious, we can debate and talk about how you do it, because then with all the moving pieces, Excel is good, and then it becomes a little bit harder to track over time. But I rather like that you do it in Excel than just you don't do it. The manual review, let's call it an eyeballing review, I guess, unless you write down all the fees. That's good. And sure. Well, thank you for sharing this. I think it's helpful for also you guys that have those results live.
Great. And here we've got examples of some dashboards that we create. And as you can see, they're dynamic. It visualizes that data in an easy to understand way. Additionally, you can export the Excel that supports these KPIs and charts. And if you want to play with it that way, as 45% of you are currently using Excel. So we want to make it easy, but also allow data export for those who really want to dig into the specifics. Some of our dashboards also will automatically track your contract price or your baseline price to catch if there's any discrepancies there, new products, new accounts that have been opened, so that you can just easily visualize that and request a credit if you're owed one from a price change, or just open that dialogue with your relationship manager. How and why did this change? Are we able to lock things in, under a contractual period if that has expired for you? And why would we want to use dashboards and technology? Well, these can accept any type of file, PDF, EDI, CAMT, and it takes that effort out for those of you who are eyeballing it, using PDFs or downloads from your bank portal. It helps standardize and aggregate data, much like Tom's solution. We're going to give you an apples to apples comparison of bank fees rather than trying to figure out this AFP code that the AFP says means one thing, but all your banks have it slightly different. A lot of times banks will throw things into the 999 category, you know, to make it easier for themselves, or it's just something that's not explicitly defined by AFP and they have no other place to put it through no fault of their own. As I mentioned, we're tracking errors, and we are also able in both systems, what are the monthly variances here? Is there anything I should be concerned about? Are my wire repairs spiking this month? Maybe returns, you know, are going crazy, or your check volume increased for some reason, which is driving up costs. And just being able to access this data visually on a monthly basis as those files roll in is invaluable. Additionally, we should be checking, we haven't mentioned this yet, but we should be checking our ECR or our interest rates on our account. Make sure that that's keeping pace with any increases, and then that it's not, you know, jumping down when there's decreases. Like if there's a 25 basis points decrease, did they get you 50 basis points? Just keeping track of that and making sure that those rates are fair to you. And additionally, there's the opportunity for custom reporting. Go ahead, Stephan. I sounded like you wanted to add something there.
No, I was thinking about this review of the ECR. We have a quarterly review of ECR through a free program, by the way, guys, where we see the median, we see the first quartile, second quartile, third quartile, and there is too much difference. There is only one money market fund rate or one, you know, yield rate in the market. With that, everything should more or less be aligned with this rate and go up or down according to the market rates. And unfortunately, it's spread out everywhere. So sometimes you don't have enough balances. Sometimes it doesn't matter, but it's just one item that you can control, talk to your bank, and make sure they keep with the trend.
Perfect. And so again, coming back to understanding the context that bank fees shouldn't be viewed in isolation, right? I know Stephan has mentioned we want to maintain good relationships with our banks, you know, for credit and other, you know, operational support. So keeping open dialogue with our relationship managers and just checking in ideally quarterly just to see what's going on with them and keeping them abreast of any you know, potential credit raises on your part or changes that may be coming for your organization, maybe the implementation of a TMS or a new ERP system, and just making sure that you've got no surprises from them and they've got no surprises from you. Also, understanding how the bank sees your RAROC, your risk level to them, because that can really impact fees and also the ECR they're giving you, in addition to the balances you're keeping with them, which impacts your interest rates and ECRs.
And when we speak, sorry, Christin, when we speak about RAROC, when we speak about RAROC here, which is kind of a barbaric name, people know or don't know. Another way to say that, and I insist on this as a former banker myself a long time ago, is that you gotta have a notion of your credit profile. That you need to know if you're publicly quoted and you have a rating, fine. But if you're private or if you don't have a public rating, you need to have a discussion about your rating. That can impact your bank fees. It's just a risk-reward approach. It's okay. There's nothing bad, nothing you know, good out of it. Just it gives you a kind of a notion, and maybe that can explain why fees are more expensive in sometimes, because it has to cover the risk as well.
Exactly. And just keeping in mind, you know, that fees are in a range, not a single point. And we've had great success sometimes working with banks, helping get an overall cost decrease, but that being fair with them, and that sometimes maybe to help you achieve that goal, they do increase some things or change some things, and working with them in an open and friendly manner. And, you know, just keeping in mind that's not the only component of your relationship. And I'm going to toss it back over to Tom here for some key takeaways.
Yeah, absolutely. So considering the complexity, I really like how both of you brought up AFP codes because I do see a lot of commonality between AFP codes and interchange codes. Um, I mean, it's hard for a merchant to discern which one is one that's preventable, which one you're going to have to accept. I mean, the same goes for interchange, right? So some of these downgraded interchange reason codes coming in, it's hard for a merchant to tell which is which and how to mitigate some of them, right? So I think the first step is simplifying any complexities there. So being able to visualize or have a lookup in order to tell which fees are controllable. I think that's certainly a benefit that can come from the complexity of both banking fees and payments fees. And then just putting the time or creating a team in order to do it. Depending on the size of the organization, I don't think this is a job for one individual person, right? So being able to build out that team in order to simplify the complexity associated with both payment and fee types coming through. I think that's certainly helpful. Stefan, do you have any thoughts on that?
I have a lot of thoughts on that. We said the webinar was about 2 hours and a half. Okay.
A whole career thinking about it.
Brian, don't freak out, Brian. I'm gonna make it short. We just debated and talked about the complexity, right? The numbers are here, a lot of codes, they change, etc. People, they don't, or they do it with Excel. If they do it with Excel, this is great. If you don't do anything, I think it's worth the time. I hear, okay, you're gonna pay your bank fees whatsoever. You're gonna pay them every month, and it's sometimes just like, is it worthwhile doing it? Is it worth the time? I wanted to bring this number, the 8% of not just like the price increase naturally, just like if you don't track the change, you're gonna have this 8% cost over time. If you pay $200,000 in fees, gross fees, it's $16,000. If you have a bank fee monitoring system, at least it's gonna track, identify, and tell you things. And it comes to that is the opportunity, right? The opportunity is the amount, and you decide if it's worth the time or not. Another thing in terms of partnering is partnering with your bank. Of course, you can partner with me anytime, but with your bank. But to partner with your bank, you need to know what to tell them. So track, communicate, guide, and engage this conversation with your bank. Whenever you see a difference, send an email. That's it, and explain. So it's also like this relationship where if we see that you are tracking your fees, then maybe bankers are going to be also more proactive in terms of the change to come and more into the communication. And it's not just a negotiation thing. The 8% inflation, yes, you have to negotiate, but the 7 or the 6.8% of cost of doing nothing because you have too many violations or discrepancies. This is kind of on us, on you, on us, on everyone to manage. So it's really that was the main point today. We totally understand. We are all in this business of bank fees, payment fees. We are advisors. We do have technology to promote. At the end of the day, we see what's happening every time we are engaged, and we just wanted to raise this point to you guys and make sure that you know what it costs you, and then it's up to you to decide what you want to do with it. I try to be quick, but I wanted to speak again.
Oh, good. I think you covered everything there. And then one thing I wanted to add as well to that is looking at Excel versus using analytics. I think analytics makes trending a lot easier. Looking from cell to cell, trying to track using graphs in Excel makes it much more difficult to actually see where they're saving. So I think analytics provides a large perspective there. And I liked your poll question because of that. It points out a lot of these merchants are using Excel, and it is great at the end of the day. I love Excel too. But analytics provides that in-depth insight that you just can't get from Microsoft Excel.
Sure. So if you have any questions, just type them into the chat box and we'll answer.
So we have a chat box here. I don't know if you can see that or in my screen or not.
I cannot.
Okay. Okay, so RAROC, risk-adjusted return on capital. I'm going this like maybe backward, but copy of the deck. Yes, we'll have a copy of the deck, everyone. So I don't think there are like other type of questions here. If you have questions, do not hesitate right now just to put them on the chat, and we can also send you a written answer of those questions a little bit later.
I think both of our emails are on the slide as well. If anyone wants to email any questions or any thoughts, please feel free.
So I think we're good. We covered it all. Thank you for being there.
Indeed. Thank you, Stephan. Thank you, Tom. Thank you, Christin. And thank you, everyone, for joining us today. Today's webinar slides and a recording of today's webinar will be sent to you within 5 business days. And for more on saving on bank fees, be sure to check out the Treasury Update Podcast, episode 304, by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.